The accounting cycle. Introduction. The accounting cycle is a systematic process used by businesses to identify, analyze, and record their financial transactions. It begins when a transaction occurs and ends with the preparation of financial statements. This cycle ensures that financial data is recorded accurately and consistently, allowing for the generation of reliable financial reports. Steps of the accounting cycle. Step 1. Identifying and analyzing transactions. Description. The first step involves identifying all financial transactions that have occurred during the accounting period and analyzing their impact on the financial position of the business. Process review source documents like invoices, receipts, bank statements, and contracts to identify transactions that affect the financial position of the business. Example: a company receives an invoice for office supplies. This transaction needs to be recorded. Step 2. Recording transactions in the journal. Description. Once transactions are identified and analyzed, they are recorded in the journal, also known as the Book of Original Entry. This involves creating a journal entry for each transaction. Process: create a journal entry for each transaction, specifying the accounts affected and the amounts involved. Example: debit the office supplies expense account and credit accounts payable when recording the purchase of office supplies. Step 3. Posting to the ledger. Description. After transactions are recorded in the journal, they are posted to the general ledger. The ledger contains accounts where similar transactions are grouped together. Process: post each debit and credit from the journal to the appropriate account in the general ledger. Example: the office supplies purchase is posted to both the office supplies expense account and the accounts payable account in the ledger. Step 4. Preparing an unadjusted trial balance. Description. An unadjusted trial balance is prepared to ensure that total debits equal total credits after posting to the ledger. This helps identify any errors in the recording process. Process: list all accounts from the general ledger with their debit or credit balances to create an unadjusted trial balance. Example: if total debits and credits match, the books are considered balanced. If not, errors must be identified and corrected. Step 5. Adjusting entries. Description. Adjusting entries are made at the end of the accounting period to account for accrued and deferred items that have not been recorded yet. Process: record adjusting entries in the journal and post them to the ledger. These entries ensure that revenues and expenses are recognized in the correct accounting period. Example: adjust for prepaid insurance by recognizing the portion that has been used as an expense. Step 6. Preparing an adjusted trial balance. Description. After adjusting entries are made, an adjusted trial balance is prepared to ensure that the accounts are correctly balanced and ready for the preparation of financial statement. Process: create a new trial balance that includes all adjustments to ensure debits still equal credit. Example: the adjusted trial balance will now reflect the correct balances of all accounts after adjustment. Step 7. Preparing financial statements. Description. Financial statements, including the income statement, balance sheet, and cash flow statement, are prepared using the adjusted trial balance. Process: summarize the financial performance and position of the company by compiling these statements. Example: the income statement is prepared first, followed by the balance sheet and cash flow statement. Step 8. Closing entries. Description. Closing entries are made to transfer the balances of temporary accounts, e.g., revenues, expenses, to permanent accounts, e.g., retained earnings. This resets the balances of temporary accounts to zero for the next accounting period. Process: record closing entries in the journal and post them to the ledger to reset the balances of temporary accounts to zero. Example: close the revenue and expense accounts to retained earnings, resetting their balances for the new period. Step 9. Preparing a post-closing trial balance. Description. A post-closing trial balance is prepared to ensure that total debits equal total credits after closing entries are made. This ensures that the accounts are ready for the next accounting period. Process: prepare a final trial balance after closing entries are made to confirm that only permanent accounts remain. Example: the post-closing trial balance will only include asset, liability, and equity accounts. Step 10. Reversing entries. Optional. Description. Reversing entries are made at the beginning of the new accounting period to simplify the recording of future transactions. These entries reverse certain adjusting entries made in the previous period. Process record reversing entries at the beginning of the new accounting period, which reverse certain accruals or deferrals made in the previous period. Example A. Reversing entry may be made for an accrued expense recorded in the previous period, so that the actual payment can be easily recorded when made. Detailed explanation of each step. Each step of the accounting cycle plays a crucial role in ensuring the accuracy and completeness of financial records. By following the accounting cycle, businesses can systematically record their financial transactions, identify and correct errors, and prepare reliable financial statements.